By the late 1920s, America looked unstoppable. Factories were producing more goods than ever before, skyscrapers were transforming city skylines, and Wall Street had become the center of a national obsession. Wealth appeared to be multiplying everywhere at once. Luxury cars rolled through crowded streets, jazz clubs stayed alive until sunrise, and newspapers constantly celebrated what they called a new era of permanent prosperity. To millions of ordinary Americans, the stock market no longer felt dangerous. It felt inevitable. Teachers, factory workers, barbers, and office clerks all started buying stocks because everyone around them seemed to be getting rich. The market became less about investing and more about social momentum. And this is the part most people never notice. Financial bubbles become truly dangerous when success starts feeling normal. Once people begin seeing rapid wealth as an expected part of life, risk becomes psychologically invisible. The market was no longer driven by caution or analysis. It was driven by collective belief. But underneath all the excitement, Wall Street was quietly changing into something far more fragile. One of the biggest forces fueling the boom was margin trading. Investors could buy massive amounts of stock using borrowed money while putting down only a small percentage themselves. That meant profits could grow incredibly fast if prices continued rising. And for years, they did. Brokers aggressively encouraged leverage because rising markets benefited everyone involved. Banks extended easy credit. Financial firms pushed speculation deeper into society. Every new wave of buyers pushed prices even higher, which convinced even more people to enter the market. The system began feeding itself psychologically. Rising prices created confidence. Confidence created borrowing, and borrowing created even higher prices. But leverage has a hidden cost. Debt makes financial systems extremely sensitive to even small declines. And this is where the danger started becoming structural instead of emotional. The entire boom slowly became dependent on stock prices never falling. What made the situation even more unstable was how disconnected the market became from economic reality. Many companies saw their stock prices explode far beyond what their actual profits could justify. But almost nobody cared anymore, because speculation itself had become profitable. Newspapers glorified successful traders like celebrities. Wall Street brokers were treated like financial prophets. Even President Herbert Hoover publicly spoke about America being closer than ever to defeating poverty permanently. That kind of confidence changed public psychology completely. People stopped preparing for downturns because downturns no longer felt possible. And once a society begins believing collapse cannot happen, risk-taking accelerates rapidly beneath the surface. But this is where the system becomes most dangerous. Bubbles rarely look terrifying while they are expanding. They look intelligent, modern, exciting. Every warning sign gets dismissed because optimism feels safer than doubt. By 1929, stock prices were rising much faster than the real economy itself, debt levels were exploding, and speculation had become deeply embedded into American culture. Yet almost nobody saw this as instability. In fact, the closer the market moved toward collapse, the safer everything appeared on the surface. And that illusion of safety is exactly what made the coming disaster so devastating. What made the 1929 bubble truly dangerous was not just optimism. It was the invisible debt machine growing underneath the market, while almost nobody paid attention to it. By the late 1920s, Wall Street had become deeply dependent on borrowed money. Investors were no longer simply buying stocks with savings. They were using leverage to multiply their bets. Through margin trading, people could purchase massive amounts of stock while paying only a small percentage up front. Brokers covered the rest through loans. If prices continued rising, profits looked enormous. A small investment could suddenly create life-changing wealth in weeks. And because the market kept climbing, leverage began feeling less like risk and more like a shortcut to success. That psychological shift changed everything. Once borrowed money starts producing easy gains, caution disappears incredibly fast. The system fed itself from every direction. Banks extended easy credit because speculation was profitable. Brokers aggressively encouraged margin accounts because rising trading activity generated huge commissions. Newspapers celebrated ordinary people becoming wealthy through stocks, which pushed even more Americans into the market. And this is the part most people never notice. Debt does not feel dangerous during expansion. It feels productive. Rising markets create the illusion that leverage is intelligent, because success temporarily hides fragility. By 1928, billions of dollars had flooded into margin trading, and much of Wall Street's prosperity now depended on stock prices continuing upward indefinitely. The market was no longer standing on real stability. It was standing on confidence, supported by debt. But leverage creates a hidden chain reaction inside financial systems. The moment prices stop rising, borrowed money turns into pressure. Investors who purchased stocks on margin could be forced to sell if their positions lost too much value. These were called margin calls. Brokers demanded additional cash immediately, and if investors could not pay, stocks were liquidated automatically. That mechanism made the system incredibly unstable because falling prices could suddenly trigger waves of forced selling across the market. What looked strong on the surface was actually extremely fragile underneath, and yet almost nobody worried about this because the boom kept rewarding aggressive behavior. Economists publicly claimed America had entered a permanently prosperous era. Powerful bankers dismissed concerns about speculation. Even experienced investors convinced themselves modern finance had become too advanced for catastrophic collapse. But this is where financial bubbles become most dangerous. Systems built on leverage require continuous optimism to survive. The moment confidence weakens, the debt supporting the boom starts pulling the entire structure downward. By 1929, small warning signs were already beginning to appear beneath the surface. Certain stocks stopped climbing as aggressively. Some major investors quietly began reducing exposure and moving into cash. A few financial insiders started questioning whether prices had become detached from reality. But public optimism was still overwhelming, which made skepticism socially unpopular. Most people ignored the cracks because making money felt easier than asking difficult questions. And that's what makes speculative manias so deceptive. The closer they move toward collapse, the more stable they appear. But underneath Wall Street's confidence, the debt machine had already become too large, too interconnected, and too dependent on endless growth to survive even a serious slowdown. The system looked powerful. In reality, it was becoming one shock away from panic. In October 1929, the illusion finally began to crack. For years, Americans had been conditioned to believe the market could only move in one direction. Every dip had recovered. Every warning had been dismissed. But suddenly, prices stopped behaving the way investors expected. At first, the decline looked temporary. Traders called it a healthy correction. Financial newspapers reassured the public that prosperity remained strong. But underneath Wall Street, something far more dangerous had already started happening. Confidence was weakening inside a financial system built entirely on leverage. And once fear enters a leveraged market, small declines can spiral into catastrophe incredibly fast. On October 24th, later known as Black Thursday, panic exploded across the New York Stock Exchange. Massive sell orders flooded the market so quickly that ticker machines fell behind by hours. Traders could not even see real-time prices anymore. Crowds gathered outside Wall Street, desperately searching for information, while brokers screamed orders across packed trading floors. Wealth that had taken years to build began disappearing in minutes. Some of the most powerful bankers in America attempted to stop the collapse by publicly buying major stocks to restore confidence. For a brief moment, it seemed like the panic might calm down. But this is where the system changed completely. Investors were no longer driven by greed, they were driven by survival. And fear spreads through financial systems much faster than optimism ever does. What happened next was even worse. On Black Tuesday, the market collapsed into full-scale liquidation. Investors rushed to sell before losses became catastrophic. But millions had purchased stocks using borrowed money through margin accounts. That created a brutal chain reaction. As prices fell, brokers issued margin calls demanding immediate repayment. Most investors did not have the cash. Their stocks were sold automatically to cover debts, which pushed prices even lower. Those falling prices triggered even more forced selling. The market entered a self-destroying cycle, fueled entirely by leverage. And this is the part most people never notice. Crashes become violent not simply because investors panic, but because debt removes the ability to stay calm. Once leverage dominates a financial system, fear becomes mechanical. Investors are no longer choosing to sell. The system forces them to sell. Entire fortunes vanished, almost overnight. Some traders who had looked wealthy only weeks earlier were suddenly ruined beyond recovery. Newspapers printed stories of devastation across the country. Rumors spread faster than facts. Banks grew nervous about their own exposure to collapsing markets. Businesses started cutting expansion plans, and consumer confidence began evaporating. But the stock market itself was only the first domino. The real danger came from how deeply connected Wall Street had become to the broader economy. Loans, banks, businesses, and consumer spending were all tied together through confidence and credit. Once those foundations weakened, financial stress began spreading far beyond the trading floor. Factories slowed production, companies reduced hiring, banks faced mounting pressure from nervous depositors. And millions of ordinary Americans who never directly owned stocks still found themselves pulled into the disaster anyway. The terrifying reality is that the crash did not destroy America in a single day. It shattered the psychological belief that prosperity was permanent. And once that belief collapsed, the entire economic system started turning against itself.